Hey, my next guest says that low rates, let's face it, they do feel good, at least for now, but also can plant seeds for the next crisis. In fact, she goes on to write in her most recent note that the interest rate markets are getting, quote, funky again. All right. I'd like to bring in Quadratic interest rate volatility and inflation hedge ETF portfolio manager, Nancy Davis. All right, Nancy, I like that. They get funky, right? I mean, I'm from the 70s music, so I'm running.
You got the suit for
today. As soon as I hear that, I want to
funky.
Casey and the Sunshine Band. But
I know.
When was the last time this sort of thing got funky? And what were the ramifications?
2019 was the last time it got funky. And what I mean by funky is the repo market. And that's why later this week, we're probably going to see the Fed not only lower rates, but they're also going to come out and say we're ending quantitative tightening because Powell probably doesn't want the repo market to blow up again on his watch. If you remember, in 19, pre-pandemic, the repo is like the grease of the wheel, right? It keeps everything going. You have to have the repo market functioning correctly. And we've seen reserves being drained, repo rates are spiking again, and so that's what I mean with the funky comment.
When the repo rates spike, what is that a signal of, though?
Well, it's kind of weird, right, with the Fed cutting rates to have repo rates going higher. So the Fed controls that overnight policy rate, but it's just the Fed funds policy rate. So when you see SOFR rates spike, repo rates spike, that kind of is a sign of stress in the economy.
So it's so interesting because I also saw one of my favorite guys, Jeffrey P. Snyder, saying the same thing, that Fed repo facility over the past 2 weeks will force the Fed to cut rates and stop quantitative tightening. Now, I guess the conventional wisdom was that the Fed would stop QT next year. If they do signal this week that they're going to stop that, or sooner rather than later, will the street be happy about it, or could it be a red flag that the economy is worse off than we thought?
I think it's a red flag because they should be stopping bond buying, right? It's like a kind of crazy thing that happened during the pandemic. We had more QE in the 8 weeks after the start of COVID in the US than we did in the 9 years prior. And so having the Fed let the balance sheet roll off and do quantitative tightening is a healthy sign for the economy, and the fact that they're kind of easing off on the brakes. I think, that's the thing. You want to watch the rate market because it's kind of the cracks beneath the surface, and it shows you sort of what's kind of underplaying the economy.
You talk about low rates in two ways. I like in your note, artificially low rates and the Main Street impact. Yeah. Hurts workers, boosts assets, widens inequality. I'm not sure inequality could get any wider than it is, but this could be one of the consequences.
Yeah, I mean, I think that's part of the problem that we've had this. If you're not an asset owner, if you don't own a home, if you don't own stocks, if you don't own financial assets, the gap between those on, asset owners and those who are not is widened. And it's harder and less affordable to buy a home now. Prices are higher, mortgage rates are still high. So you just definitely have this huge gap between those who have and those who have not.
Low rates and the impact potentially on financial markets. Again, correlation spike, poor diversification, bubble risk. What's the timeline for some of this, though? It's not instantaneous, though, right? I mean, this wouldn't happen if we get a couple more rate cuts. Would this be like an immediate danger?
Well, I think it's just a question of being diversified. You just want to make sure your portfolio is not correlated with one another. And I think that's the problem, is people feel really good right now with ego, right? Everything you buy has been going up. And so I think it's just really important when everything's going up together, you have to take a step back and say, are these things correlated? Like the last time I was on your show, we talked about credit, right? If you have bonds with credit risk and you have stocks, you have a very similar corporate beta. And a lot of people are hanging out in floating rate notes right now, whereas over 80% of those notes are trading above par. So with the Fed cutting rates and credit being really tight, you could kind of have a double whammy with interest rates moving lower and credit spreads widening. So I think it's just a time to be prudent, to know what you own and how those risks are correlated.
What's good about it is that if you are prudent, disciplined, you see it coming. It won't, if it sideswipes you, it's your fault. I mean, really, right? Yeah. I mean, because the writing is sort of on the wall if you choose to see it.
Yeah, absolutely. No, diversification is always the key.
As always, Nancy, thank you very much.